Hello, this is Brandon Christy again with Retirement Benefits Institute. I'd like to cover a few sound financial principles with which we are all familiar. If exercised, these can have a profound impact on your financial picture and help prepare you for a confident transition into a comfortable retirement. Number one, be in a hurry to get out of debt. Eliminating debt minimizes the financial stress felt by the compounding effects of interest rates. Taking control of this area of your life allows you to focus energy elsewhere, renovating your dream home renovations, traveling, helping kids with college, giving to your favorite charity, and setting up for financial freedom in retirement. MoneyCrasher.com has a list of 25 reasons to get out of debt today, some of which are here for your enjoyment. Free up household income. You have more money to invest in retirement accounts. It greatly reduces the risk in your life, helps improve and maintain healthy relationships with your spouse, family, and friends, and the feeling of owning a house or a car is outright awesome. There's more to be seen at MoneyCrasher.com. Our next topic, don't borrow on what depreciates. According to Forbes, purchasing a new car is a terrible investment, but what's worse is purchasing a new car using credit. Paying for a vehicle with credit generally results in immediate loss due to depreciation. In addition, you are paying interest payments, making the cost of the vehicle higher than the initial purchase price. If you know you will need a car in the next 5 years, you can go ahead and start paying yourself a car payment. This will enable you to purchase the vehicle with cash, eliminating interest payments and giving you greater leverage in negotiating the price. Next piece of advice, continuously evaluate your needs versus desires. Webster's defines needs as a situation in which someone must do or have something. On the other hand, desire is to want or wish for something. As you look at your monthly expenses, needs come first. Dave Ramsey suggests an envelope system where you have cash on hand for different categories of expenses, like dining out, bills, clothing, etc. As human beings, we have an emotional connection to cash. The pain of breaking the connection helps reduce the impulse buying as you can visually see the cash disappear as you spend it. In contrast, swiping a debit card does not have the same emotional effect. Once the cash envelopes are empty, your budget is reached and the cash is not there to spend on your desires. Next point, allocate expenses in advance. There are things in this life that we can control and other things that we cannot. Birthdays, holidays, car insurance premiums, to name a few, are expenses we can plan for throughout the year. Since you know they are coming, you can allocate cash each month to these funds in advance. The money will then be available when the bill comes due or in December when Christmas comes. It may help you to divide regular non-monthly payments down so they're monthly costs. So, for example, if you spend $3,000 a year on a summer vacation, block that out as $250 a month. Next point I'd like to bring up is, you ready for this? Make a budget. Budgeting is not something most people would describe as fun. The average person is more likely to deem the budget as the B word and not talk about it, something best not thought about even. However, budgeting is crucial to sound planning. Delaying planning could close off financial options that you might have otherwise had. Build out a basic framework for your budget that includes household expenses, auto expenses, groceries, dining out, clothing, and gifts. Don't forget the little things. We recommend reviewing 6 to 12 months of previous spending to determine where your money has actually gone. There is a tendency to underestimate what we spend on discretionary purchases, but they in the form of nice dinners out, expensive treats, or those extra gifts for the grandchildren. When drafting your budget, the most important family member to include is, of course, your spouse. Financial pressures are one of the largest drivers of marital conflict. Although including your spouse in all aspects of your retirement planning may be an unpleasant process at first, it's important that you and your partner are on the same page. Even if you are the one monitoring and planning finances alone, your spouse can keep you accountable and on track, but only if he or she is kept informed. If you're single, we encourage you to find an accountability partner whom you can trust to tell you the straight truth and help hold you accountable. To assist you in your efforts, we've included a sample budget worksheet for you to review. Next, you want to make sure you have enough cash for the transition period. Typically, federal employees retiring need 6 to 9 months before final adjudication of your pension check. So to prepare for that, you may only get 75% of what you're hoping to get. You'll need some cash on the sidelines. Well, you can utilize your unused annual leave. You will receive a lump sum at retirement for the balance of your unused annual leave, typically arriving 4 to 6 weeks after separation. These funds may help you cover the gap between your former salary and the reduced pension amount. Okay? How can we help? Well, we are glad to be a resource to you and to your family. You can check us out with more videos here on YouTube. Subscribe to our channel. We'll continuously put good information out there for you. You have retireinstitute.com. We have analysts standing by waiting to assist you to help walk through your federal benefits, put all the pieces together. We can even do some walk through the budget document that you can view. We are glad to be a resource for you as you prepare for retirement. It's not easy, oftentimes it's scary, but please contact us at 877-864-1145 and we'll be glad to help.